Robert Ophèle, who is the chairman of the French AMF, well known to us all in Brussels. He spoke at our conference before, and he's also a very keen observer on the trends and the impact of technology on wholesale and securities markets. And with that, I will pass over to Robert in just a minute. I think it's also just interesting that the AMF has been very much at the forefront of a number of papers and documents in the last year or so on the impact of technology on markets, and also how MIFID should be restructured, could be restructured. Most recently, an interesting paper together with the Dutch markets regulator on data use and data parties. With that, Robert, I pass over to you without any further introduction. If they don't know who you are, they shouldn't be on this call. It's good to have you with us.
Thank you very much, and good afternoon, and hello to Carmine. I've properly listened to your chat, and I should say I'm fully in line with what you said. A global pandemic has dramatically accelerated the place of digital in our daily lives, in our social relationships, whether personal or professional. We have all used Zoom and Teams conference call. Proof of this is today's event. In our daily consumptions, at a time of lockdown, we have witnessed an explosion of online purchases. Digital has even taken a dominant place now in our wallets. 1 out of 2 payments was contactless in 2020 in France, against 35% in 2019. This afternoon, I will touch upon the changes that digital acceleration could bring for financial market and the players that revolve around them. 2 issues seem to me to be particularly relevant for the years to come. First, how the combination of data, algorithm, AI, and social media, all of them, will reshape financial markets. And second, if and how the recourse to distributed ledger technologies, DLTs, will profoundly redesign our markets. Both trends have recently demonstrated how they could bring irrationality to financial markets. The first with the Reddit GameStop episode you have just mentioned, and the second with the Bitcoin saga worth $10,000 last September and $40,000 at the beginning of January. However, I do think that well managed, both trends could bring democratization and efficiency to financial markets. Let me say a few words about each of them. Data, algorithm, AI, and social media, all of them have overwhelmed our private life. They are now shaping the structure of our financial markets, how to take a better advantage of them. First, we should ensure a simple and fair access to reliable data. At the heart of the digital world lies data. In God we trust, all the others must bring data, as used to say Edwin Deming, the American statistician. Nowadays, we have a lot of them, so many that to some extent, only big players have the capability of exploiting them by first cleaning up existing databases, then developing algorithms and power them with artificial intelligence. It is time to rationalize the dataset and facilitate access on equal footing by the widest possible population. In Europe, with regard market data, we have dramatically increased market transparency, be it pre or post-trade transparency. But the cost of usable market data is huge, much too huge. We urgently need consolidated tapes. It is one of the main purposes of the MIFID review underway. Regarding issuers, we have many. In that perspective, what is in the pipe in Europe is also promising. We are about to enable almost real-time digital access to regulated information First, ESEF, the European Single Electronic Format, will facilitate accessibility analysis and comparability of financial reports through a normalized electronic format, and before long, through ESAP, the European Single Access Point, every financial and non-financial information disclosed by issuers will easily be accessible in a single and normalized database. The EU Commission has clearly indicated that a legislative proposal is about to be delivered, and in order to do so, a targeted only 12-week consultation has been recently launched. You have mentioned that a few moments ago. Providing fair access to reliable data in a non-fragmented way will reduce information asymmetries, expand the range of market participants, and enhance an effective price formation mechanism. The second axis of the digital acceleration is in the financial world is the rise of platforms allowing retail to trade and chat online. Providing access to trading at a very low cost to retail is a very way to democratize financial markets. The lockdown periods we have experienced last year has coincided in France, as in almost all countries, with a substantial increase of retail clients' activity in equity markets. Many of these clients are new ones, much younger than regular investors, and they are trading through online brokers. This is a far-reaching evolution, departing from the usual but costly European intermediation model through the banking system and the associated duty to offer proper advice with the corresponding suitability requirements. It also opens the way to a new way of consuming financial products with the emergence of one-stop shops or the possibility for an investor to access a range of services in a single place with a complete vision of its assets thanks to aggregation services and the possibility to choose between several types of investment, be it crowdfunding, money market funds, crypto assets, socially responsible investments, equities, ETFs, loans, grants, and so on, etc. At this stage, few companies have emerged on this segment in continental Europe because of our distribution model, which to date remains concentrated around large institutions. But for me, it is clear that Europe will not spare the online financial supermarkets that have sprung up recently in some jurisdictions. Empowering customers with this almost direct access to market is very welcome, but raises many questions. It opens new ways to distribute very risky and leveraged products without the proper safeguards, new way to manipulate markets using the social media dimension of many platforms. To some extent, intermediation through firms providing investment services has its benefits for investor protection purpose. On their own, retail customers could be more prone to embark in some dubious investment and to feed financial bubbles. In that perspective, we should keep in mind the provision of the European Market Abuse Regulation (MAR). Persons who produce or disseminate investment recommendations or other information recommending or suggesting an investment strategy shall take reasonable care to ensure that such information is objectively presented and to disclose their interests or indicate conflict of interest concerning the financial instruments to which that information relates. Furthermore, the European Commission's initiative of the Digital Service Act and the clarification it provides regarding the responsibility of digital platforms and gatekeepers for what passes through them is absolutely essential. Being an online platform where to some extent supply and demand meet shall not exonerate from any form of legal responsibility. This principle laid down by the Digital Service Act is fundamental in my view and is intended to apply to FOE as for any other types of services marketed through a digital platform. Let me now turn to blockchain issues. The confirmed development of crypto assets makes indispensable to rapidly regulate the market at the appropriate level. The European Commission proposal for a regulation on markets in crypto assets, MIKA, is therefore more than welcome. However, while it is necessary to build up the regulation for products that do not qualify as financial instruments, I should confess that I'm equally supportive of the other legislative proposal covering crypto assets that qualify as financial instruments. The proposal for a pilot regime, which could waive some provisions of existing regulations, is very important. MIKA will close a loophole, while the pilot regime will prepare tomorrow's financial market. So let me start shortly with the pilot regime. For market infrastructure based on DLT, infrastructure wishing to trade and settle transactions in financial instruments in crypto asset form needs to be able to carry out experiment within a proportionate and clear regulatory framework. The potential gains to be expected from DLT can be significant. It would reduce risks both by speeding up the market chain and by its distributed nature that could mitigate some cyber risks that centralized market infrastructure raise, such as the single point of failure. The use of DLT could also decrease costs using smart contracts that could simplify many back office processes. It is also a question of keeping Europe competitive at a time when similar approaches are now being rolled out in many countries. I'm therefore glad to note that this proposal is a regime of exemption from European regulations that aims to enable experimentation for the use of DLT in the trading and post-trading of security tokens, where existing legislation precludes or limits their use. Nevertheless, the draft proposal proposed by the Commission could be more audacious in my view. Let me mention three needed improvements in order to have more open pilot regime, fostering healthy competition and giving Europe all its chances in the race to technological progress. First, the current scope of the pilot regime results in a strong bias in favor of traditional actors already approved as MTFs or CSDs. Any new entrant wishing to develop a DLT MTF or a DLT SSS would have to apply first for an authorization as an MTF or CSD operator, in theory on the basis of a traditional business model. Once this first authorization obtained, it will have to apply for the exemption sought as part of an authorization as a DLT MTF or a DLT SSS. This double process is likely to discourage new entrants, bringing the pilot regime to lose some of its added value, even though this does not provide any additional protection in the context of the experimentation. The eligibility to the pilot regime should, in my view, be extended to every actor. Second, we need to broaden the range of issuers able to benefit from the listing of the securities on DLT-based infrastructures via an increase in threshold proposed. Commission intends rightly to limit the pilot regime to illiquid stocks and bonds. The draft regulation provides for capitalization and issue size thresholds below which financial instruments will have to fall in order to be admitted to trading on an MTF DLT or admitted to the operation of a DLT SSS. I think the thresholds deserve to be raised if you want to have a meaningful experimental zone. At the IMF, we are, for instance, defending the idea, notably in the context of the MIFID II review, that all companies with a capitalization of less than 1 billion should be considered as SMEs. To make the pilot scheme more ambitious, it seems reasonable to extend it to this capitalization threshold so that all European SMEs can benefit from the innovations in question. Last but not least, we could be bolder in our approach by ensuring the outset and that the principal technological neutrality is respected. Blockchain is the fast evolving technology. It would be a pity to limit technologies that we can test. That is why it should be important to clarify the possibility to test public DLT as well as decentralized finance DeFi business models into the future pilot regime infrastructure. I would like to highlight that if we limit the pilot regime scope too strictly, innovative projects could leave Europe and develop their project outside the EU. Let me finish this speech with a few words on MIKA. The European Union has also chosen to regulate crypto assets that are not financial instruments, Bitcoins, Ether, and the likes, through its MIKA proposal. It is high time when we look at the spectacular price variation of Bitcoin over the last few months. The MIKA regulation establishes uniform rules as well as passport mechanisms for initial coin offerings, issuers, and crypto asset service providers. These new provisions will undoubtedly strengthen capital market union. In that perspective, we think that a few adjustments could be made. ESMA should be the competent authority for this new area of regulation, including the supervision of crypto asset service providers. First, this would be the best way to guarantee a level playing field in the EU. Second, as this regulation is brand new, it's easier to provide the competence to ESMA at the outset than if it is considered at a later stage. Moreover, it would make sense to gather all the expertise in the same authority, as the cost of entry in the crypto world is quite high. Still on the subject of competencies allocated to ESMA, MIKA establishes specific rules for stablecoins, distinguishing between asset reference tokens and e-money tokens. While it's natural that global e-money tokens replicating a single currency would be regulated by EBA, the regulation of asset reference tokens, very close to traditional financial instruments such as UCITS shares or maybe commodity derivative, this regulation by EBA is questionable. ESMA could also be the competent authority in that case. Regarding market abuse provisions, Commission's proposal provides for rules governing inside information and the prohibition of market manipulation. However, these rules appear to be very difficult to enforce. I see the need to provide in MIKA the same approach than for securities, with a transaction reporting mechanism from crypto asset trading platforms to NCAs or to ESMA, as well as making order book available to the regulator. Improvement in MIKA is also needed to ensuring that the technological neutrality principle is respected. As already highlighted for security tokens, we need to ensure that all types of DLT can be used, private or public. Nor should we close the door to the decentralized business models by prohibiting or disregarding them. I think we should favor an outcome-based approach, which means that business models capable of complying with the organizational rules, conduct rules, and AML rules should be admitted. It is obvious that a process is underway that will, from many angles, profoundly change our financial markets. In any case, we should never forget what is their purpose: financing appropriately our economies without endangering financial stability. Let us try to achieve that in this new digital environment. And I will stop here. That's 20 minutes.
Thank you very much indeed, Robert. You've raised a lot of issues. And if you permit me, we've got about 10 minutes. I might just ask you a few questions based on what you said, if I may. I think one footnote, though, which I just find interesting, we did a number of events on MIKA and the pilot project and on many other issues. We did 31 different seminars between September and December. And the one with by far the largest number of participants was on the pilot project. I had not expected that across all financial services issues, because it raises so many interesting questions, and I might come to that. But I'd like to start with the points you raised around data. And I take your point about the availability of data and use of data. I just want to come back to this question of ESG data, because you did publish this paper together with the Dutch authority. And I wouldn't say it's uncommon, but it's a new idea to see authorities from different member states coming together and writing these papers together. And what type of a proposal or vision do you foresee for the EU? What should they do and what should they adopt in this space? And more generally, based on your comments around data, what would you expect from the EU in this area?
Thank you for this question. Actually, the European Commission is planning to publish a renewed sustainable strategy in a few weeks with a roadmap. This roadmap will take on board new actions. And we had that in mind when we published our paper with our Dutch colleague, because we do hope that this opportunity will be seized to develop a framework appropriate to ESG rating activities and the related services. It is relatively simple what is behind that. We need transparency in methodologies. We need a good management of conflict of interest. We need a fair relationships with issuers, and we need some type of location of the teams. These are the chapters that need to be covered by this new framework we are advocating for, and we do hope that it will be taken on board by the European Commission in this renewed sustainable strategy. There is a lot of support at ESMA to such a stance, which is clearly requested by many issuers and by many asset managers. Some data, and it's true for ESG data, but it's also true for other data. Some data are public good with many externalities. It is a role of financial market regulator to ensure the quality and the access to this data at a fair price. That's what is behind our stance.
Thank you. And maybe I switch over to MIFID, and you already we all know that there will be a MIFID revision coming this year. And I as you were speaking, I noted down a few points, concerns about the application of advice to investors in a more and more digital environment. I know France has always been very strong on the role of advice in the interaction for retail investors. You didn't mention it very explicitly, but research. You called it, the quality of information and recommendations, but it is effectively research. And I know, again, you have fairly strong views on that. And you mentioned then that you wanted to increase the threshold for SMEs, which is linked a little bit to that. And then obviously regulated market data, and just in general, the role of disintermediation in the markets. So looking at the application of new technologies, what lessons do you draw as to what a MiFID 2.5 or MiFID 3, whatever we should call it, should do in this area?
When you are starting numbering the regulation, it reminds me the Basel Committee and Basel 1, Basel 2, Basel 3. That's not Basel 4. No, it's not Basel 4. It just targeted adjustment of Basel 3. And in that case, it's exactly the same purpose. That could be some targeted amendment to MiFID 2, because we should recognize that, broadly speaking, MiFID is a success. It's a framework that encompasses both the most basic forms of trading, such as RFQ or voice brokerage, and the most technologically advanced forms with all these algo tradings. And on the same time, what has been done in terms of investor protection is also a success, with especially with product intervention and all what is behind that, in order to limit the leverage which is sold of the products being sold to the retail. We at ESMA has already sent a large number of reports to the Commission in order to help in this review. and other in the process to be completed. View is, I will mention three. First, to make the pre and post-trade transparency system more efficient. It means to simplify it, and recalibrate some of the elements. Second, we need to guarantee access to high quality consolidated tape, consolidated data, consolidated tape. I think it's very high on the agenda. The third challenge is to ensure the preservation of the competitiveness of EU players versus those established in third countries, and obviously I have the UK in mind. Ensuring this preservation of competitiveness without any race to the bottom. We need to find the right balance. We need both of us, EU and UK, in that field. It's important that the regulatory framework provided by MIFID does not prevent the development of projects and experiments. And obviously, we had identified some legal obstacle to the development of market infrastructure project based on blockchain, and we have pointed out in a legal analysis published in March last year. Only a narrow path of innovation was allowed through the constitution of bulletin boards. When you look at MIFID right now, bulletin boards, as defined in one of the recitals of MIFID, are allowed. It could be useful to have a confirmation in level 1 regulation. More generally, the boundary, what we see right now is that the boundary between activities requesting to be registered and regulated as a trading venue, and Carmine has mentioned the high number of trading venue, be it MTF, OTF, or SI. There is a fine line between those who need to be registered and regulated as trading venue and the services that do not request such a registration. This topic is a very sensitive one, and it has been covered by the ESMA consultation on the functioning of OTFs. That's a recent consultation. We are now just covering the answer, analyzing the answers, and our conclusion will be delivered through the ESMA soon, probably beginning of April, on this issue of the boundaries, which is one of the most tricky issue, because it changes every day, because you have new services, new way of providing services in that field.
I will be certainly reading that recommendation with great interest. We always have new things to read every day. Commission this week with consultations, IOPA last week, and ESMA in April. One very last question, if I may, because it came in from Jack Chickler, and I think it is based on what you said about how do we deal with opinions emerging in social media? Is this something securities regulators need to think about or not? And you mentioned the Digital Services Act, in which case it would be a much broader piece of legislation that doesn't really cover financial services at the moment, at least. Or do you see a role there for markets and conduct regulators to intervene in the social media space, where basically individuals can issue any type of views?
I think the first concern we have is to prevent market manipulation through the use of social medias. And to some extent, you have separate social media, and some of them are part of the platforms providing the trading services. So it's important to have a close look at it. I do think that the current MAR regulation is fit for this purpose, and but it's a case by case basis. Difficult to have a clear view in general, but it's definitively something we are looking at, because we need fair market, and it's a fair market means that at some point there should be some rationale behind the valuation of the assets which are traded, and when there is none, you could have a problem. We have a problem, and we have a problem as market regulator and market supervisor. I should say that I've not seen that the EU currently, which is reassuring. But we also know that the US will, later on, come on to the EU. We should prepare to that, and we should think about it in order to avoid any to keep the good functioning of our markets.
Yes, I entirely agree. I think we see more convergence in the last month in thinking between the US and Europe on many of these issues, and the interlinkage between technology and financial services, as also between sustainability and financial services. Robert, it was a great pleasure to have you with us, as always. Hopefully next time again in person. Thank you for kind of, together with Carmony, giving us a 1 hour insight really in how technology is influencing wholesale markets, and also some of the possible revisions we might see in and around MIFID. Thank you very much indeed for being with us today, and see you soon. Thanks so much.
My pleasure. My pleasure. Thank you very much. Bye-bye.